Welcome back to the Halftime Report. It's time for ETF Edge, the XLP Consumer Staples ETF, hitting a new 52-week high on the back of strong earnings from Kimberly-Clark today, kicking off a big week for the group with a number of big names like Procter & Gamble, Coca-Cola, and Colgate all set to report. There's plenty of ways to play this space into these reports. There's the XLP, of course, that's the big daddy in that one, but also the Invesco equal-weighted consumer staples ETF, that's RHS, and there is a global consumer staple ones, that's Nestle in there, KXI is the symbol there. Reggie Brown of Cantor's ETF Group and Dave Nadig of ETF.com join me now. And Dave, we make a big deal about cyclicals like technology all hitting new highs, and yet now we have the consumer staples there. How do you explain cyclicals and a defensive group new highs?
Yeah, well, so I think new highs is a relative term. We're only up 12, 13% in the space. This is far from the high-flying segment. And as you pointed out, we have the biggest names in the sector still to report. Procter & Gamble, Coca-Cola, Pepsi, those three names combined make up 35% of the XLP. It's a lot of concentration.
Reggie, we're always talking about that concentration in these market cap weighted indexes, and yet the equal weight index, which is 30 consumer stocks, that's also sitting up there at a new high, essentially. That's 3% each. So the smaller guys are doing just as well in the consumer space. I think that's a positive overall, don't you think?
Investors love earnings and outcomes, right? So I think you're seeing a drive into the sector based on performance of underlying companies. And as you know, ETFs represent performance of underlying stocks. Yeah. So you're seeing investors want to have exposure.
And at the same time, we're seeing global consumer names up. Nestle's is in the global, the KXI. That's another alternative way to play this. So you've got three choices: global, equal weight, or market cap weight. What do you do?
I'm still a believer that we're in a global slowdown environment. I'd rather stick to the U.S. I think it's a little more understandable, a little more controllable. I would go with equal weight here again because I think that concentration, that could help you. If P&G really blows the doors off, you'll want that exposure. But I think long term, as you pointed out, the smaller names are doing as well as the bigger names. Why not give yourself a little bit of short-term diversification?
Yeah, and they're certainly holding up very well. You don't often get the same sectors moving at the same time. The smaller guys moving as well as the bigger guys here. Anything else from this group that you like?
I do think that there's an opportunity to look at alternative plays here. There are versions of consumer staples or non-cyclicals that include things like automotives. Yes. That's actually helped you if you look in the corners.
You get some outperformance if you put the autos in.
Absolutely.
Okay, we'll keep an eye on that. Thanks very much, guys.